In the middle of all of this, we did have the Federal Reserve cutting interest rates. That alone isn't a huge deal. The fact that they did it by half a point well before their meeting, between meetings, something they haven't done since the financial meltdown back in 2008, did raise eyebrows. And the traditional view seems to be, what do they see that we don't? Let's go to Jackie DeAngelis, following all this closely. Stanford School of Business lecturer Dave Dodson, and the Wall Street Journal's John Bussey. John, I do think, it's just my opinion, that I think this finger pointing and name calling and dismissiveness in the middle of something of this ilk does rattle folks, not just investors, but rattles folks. What do you think?
And it rattles. I mean, nervousness and anxiousness, you're seeing that reflected in the stock market right now because of the coronavirus and its effect on, ultimately earnings. But before that, supply chains, which are getting all bollocksed up by this. The consumer who's holding back on that vacation or travel, and then ultimately corporate earnings. So you had the Fed rate cut today. It was interesting, Neil, that they're getting really out. They're trying to get out ahead of this. I mean, they're trying to act before that they did in the 2008 crisis. They're trying to, signal to the markets that they're there. On the other hand, there's not much they can do. There's not a lot further that the Fed can cut, and that holds true for international central banks as well. Greg Ip has a story on WSJ.com right now that says that how much an exogenous event like a coronavirus can hurt the economy. It was only a half of a percentage point in the 1918 Spanish flu, about the same in 1957 and 67 when there were bad flus. But that was before an integrated supply chain globally, and that could have an unpredictable effect on companies and earnings, and I think that's what the Fed was thinking about today.
You know, if you're sitting on the Federal Reserve or you're the President of the United States, Professor, and you see that the markets didn't care or didn't have any response, save an awfully negative one, to John's point, with the cut in rates, and we're dealing with under 1% on a 10-year note, much cheaper mortgages are going to come as a result of that, and still nothing. What did you make of that?
That's the point, right, isn't it? We have a situation where the Fed drops a half a point, big deal, in an emergency meeting, hasn't been done since 2008, and it's ho-hum to the market. And the reason why that is I think what the Fed did is they said to the world, this is a big deal and we should be worried about it. But the markets are smart enough to know that we can't just keep hitting a button every time something goes wrong and says, well, the Fed's going to move the interest rates up or down and our world's going to get better. In 2008, that was a financial crisis. We had liquidity issues, we had banking issues, and that was a great place for the Fed to enter. But this is, people have a fever now, and you don't fix a fever by dropping interest rates. In what world is someone now going to go on vacation because the Fed dropped the interest rate? Or in what world is someone who is going to have a business trip tomorrow canceled? Are they going to do that business trip? That's not how you solve this problem. And then, to make matters worse, in my opinion, Trump tweeted that it wasn't enough. And so how much signaling can we send to the economy that the economy is so fragile right now that if interest rates are anything above 1%, the growth is going to stop?
You know, that's well put. You know, Jackie, what worries me the most about this, and I know a lot of people say, oh, you make a big deal of politicians being politicians and pointing fingers at each other and names and all that. But once again, much like we had during the financial crisis, it's like the whole civilized political world, if that's not an oxymoron, I don't know what is relying on the Federal Reserve to save the day. And to the professor's point, Jackie, there's only so much the Federal Reserve can do.
Absolutely. I mean, these are two totally different circumstances. So I think the initial market reaction today was the Pavlov's dog's kind of reaction, which is the market goes up a little bit when you get a rate cut, and then it starts to digest it and say, hey, yesterday we were up over 1,000 points. We were starting to pause and say, yes, the coronavirus is serious, but measures are being taken to get through it. Everybody, needs to just take a deep breath with this. Today, when you see the Fed acting in this way, it's almost an alarm bell for the market, and that's why it sold off 785 points, because to the previous points, you can solve a liquidity crisis with interest rate cuts, but the consumer is in charge here. If the consumer gets scared, isn't going out, isn't shopping, isn't traveling, isn't doing all of those things, you're not really going to be able to stem the damage that occurs, that comes to the economy. And that's what everyone's worried about. It was Goldman Sachs and Citi last week saying that if the coronavirus really does become this pandemic that people think it could become, you're going to see earnings growth wiped out for 2020. And that's the issue. Interest rate cuts really aren't going to help that.
Yeah, you got to prepare people for that,
John.
John.
Jackie, haven't we also shown the world that we don't know what we're doing when a pandemic hits? Because this is a relatively mild virus. hopefully we'll only have about a 1.5% fatality rate, which is still high. And we don't know what we're doing. And within a matter of weeks, something that starts in rural China is in 30 countries. So what happens when we have SARS, where it's got a 10% fatality rate?
Yeah, and we don't have the correct number of cases of that. And so whether the numerator or denominator changes or not, the fact of the matter, John Bussey, is people generally don't trust what they're being told. They were told that it wasn't a problem here. Suddenly it's a big problem here. They were told that it wouldn't spread much beyond Asia. It spread to better than 60 countries well beyond Asia. So they don't really trust anything or anyone. That's a very big differentiator.
Yeah, it's a difficult situation. Jay Powell said as much, that, look, my rate cuts not going to fix the supply chains that are getting very seriously disrupted by the virus. And your point's well taken. I think that the market's looking at this. It's buy on the rumor and sell on the news. That's why we saw the fluctuations yesterday and today. But longer term, the market's looking at this and saying, look, we see the trajectories that happened in Korea and in China and in Italy, and the presumption is that it won't be any different in the United States, probably a safe bet. That's a concern, particularly when testing was, there were problems with testing. The CDC didn't have a proper kit at the beginning. There's questions in the market about the preparedness of the United States for those trajectories when they do come to the United States.
All right, final word. I want to thank you all very, very much.